Hi, this is Jason, and welcome back to Red Pill Finance TV. In this episode, I want to go back in time to the bull run of 2017 and how it ended in 2018. So, 2017 was really the first year where there was significant attention on Bitcoin and cryptocurrencies in general. So there were features on, say, newspapers, TV, Bloomberg, Yahoo Finance, what have you. So it's really heating up that year. And for us everyday consumers or retail investors, when we see something new that's in the media, getting a lot of coverage, seeing week on week significant price increases, and perhaps hearing our friends talk about Bitcoin, that is when we come into this concept called fear of missing out, or rather FOMO. So there's a lot of FOMOing happening around the summertime period of 2017, where you see the price going up, you think, oh, you've missed your chance, and you're waiting for the dip or a retracement. That doesn't happen, and it goes further higher, and then you just get in because you don't want to miss your train. And that's just a compounding effect. And the people who get in later are obviously the people that are worse off. Getting in at the end, when it hits the top, is the worst time to get in. Now, that year, a lot of things were happening, not just the effect of FOMO. There was also a lot of ICO activities, which is basically initial coin offerings, which we'll talk about in a second. There was also a lot of forks that were happening, so a derivative of a cryptocurrency that's created. And there's the introduction of futures as well that basically propelled Bitcoin to all-time highs and shortly after saw its demise. So a lot happening in that year and a lot of price movement. So let's go back to ICOs and why they are a particular issue for cryptocurrencies and leaving a taint on cryptocurrencies. ICO, as mentioned, are initial coin offerings. So these are analogous to IPOs in the traditional finance, which is initial public offering. So essentially, when a company wants to go public, they do a round of initial um, offerings of shares. So similar to that, in the crypto world, ICOs basically meant when a new cryptocurrency has a new crypto or coin or token and issuing it to the being able to purchase. So it is basically new cryptocurrencies issuing new coins. Now the issue is some of these were not in the interest of the customer, and therefore they were scam coins essentially. So what would happen is an investor would buy it because it's seeing massive gains, and then eventually what the issuer does is just dump the coins, cash out because they were the ones initially in it in the first place and had the lion's share of the coins, and then what's left is the price with the everyday consumer that bought that coin, and therefore they lost their money. And this really extends to the issue that cryptocurrencies at that point in time got a lot of attention, but it was a relatively immature market, which meant that from a government or agency perspective, there was little or no regulation, which meant no protection for the customer. So that's why cryptocurrencies, in a way, from the past had a bad reputation because people lost money. And you can see in the last year, this has changed, this has improved with the SEC filing lawsuit against XRP Ripple as well as Tether. And this goes to show that they're demonstrating that they're clamping down and they're taking it seriously. But it is just an unfortunate event that in the past, regulation just wasn't there for something so new. and a lot of customers got burnt with losing money to coins or ICOs that weren't serving their best interest. The other thing is volatility that's related to cryptocurrencies. Of course, again, with something that's new and small cap and very little volume traded in it, relatively to other assets or stocks that we see in the S&P 500, for instance, um, naturally that comes with volatility. It's not a new phenomenon, and we do see it in traditional finance as well. So, for instance, small cap coins or penny shares, or even private companies issuing rounds of funding, they have very high risk as well, and they can lose you money. The only difference is that they are more regulated, and back in the day, in 2017, cryptocurrencies weren't. Volatility is nothing new. As an industry matures and as coins get more and more interest, inevitably the volatility reduces. So those are a few things, and a theme that is related to both of them is regulation, protection of the consumer, insurance essentially, bailing out even. That did not exist. And finally, towards the end of the year, so around December, November time, um, the crypto market was just hotting up to overextended levels. So we saw, for instance, if you go and Google search trends, Bitcoin spiked to massive highs in December, in the month of December. And further to that, we also had the development of futures, Bitcoin futures being introduced. So this was by the CBOE as well as CME. And this basically allowed people to buy contracts in Bitcoin, whether it's a long or short position, in order to perhaps hedge their position. And that was really the tip of the iceberg. I remember vividly on the 17th of December, that's when Bitcoin basically got to $20,000 all-time high, a blow off top. I was actually in a tiling shop at that time going crazy. So yeah, around that time, it was just overextended. If you're into technical analysis, then in terms of the RSI, which is the relative strength indicator, that was well in the excess of 90. So it was in overbought conditions. And when it's in overbought conditions, and 20,000 is a nice round number, the professional traders, they start selling. And once that happens, and big amounts of selling, that just kicks off a cycle that goes down. And when something is overinflated, then the higher you are, the more you go down essentially. And that's what really happened when we saw that in playing out in 2018. But this time around, it is different, I believe. We have seen more institutions get onto it. We have seen more regulation. So thank you for listening to this episode, and I'll catch you in the next one.